Let me now bring on board Prakash Diwan, Head of Institutional Client Group with Asit C. Mehta. Prakash, morning. Thank you for joining us. Prakash, we are in for a busy and interesting day of trade. Locally, we have big numbers, the new listing. Globally, Euro is at a fresh 2-year low against the dollar, and the center of gravity has shifted from Greece to Spain.
No, absolutely, Nikunj. I think given the kind of momentum that we saw in the major part of yesterday's session, we are very clearly focusing on the domestic cues. And I guess today's session will also continue, and the fact that we have an expiry date tomorrow. Combined with all this, it seems that for the time being, we are willing to ignore the condition in the European markets, though I think it's not something that could kind of be completely wished away. But my sense is we'll have a range-bound mentality for trading today, and we could probably see markets actually look up, though the SGX Nifty hasn't indicated that much of an upside. But the kind of numbers, the robustness of the numbers definitely augurs well for the market, and we could probably see it also expanding to the broader markets today.
Prakash, hi, morning. Your thoughts on Tata Motors and the disappointment that we've seen from JLR this time around after missing their April sales volumes expectations. This time around, it's been an earnings miss.
That's true. I mean, the margin drop in margins is distinctly worrisome, because that is something, margins take much longer to turn around, whereas top line growth could possibly be managed rather quickly. So if April was disappointing and May is probably not as disappointing, the margin would still continue to hurt the company, and this particular quarter could probably start signaling us some sort of a move to the trough in terms of the kind of dream run that JLR has had in the last 12 months. But my sense is, we need to accept the fact that the passenger vehicle market itself is getting highly competitive, and there would be some sort of a rationalization in terms of this thing, unless companies like JLR and Tata Motors overall are able to pass on the cost. So I would definitely expect the stock to react in a slightly sideways to weaker bias. But there would be opportunities if improvement starts getting triggered somewhere in the next quarter to start buying into these kind of stocks from a more longer term perspective.
Prakash, the earnings season officially gets over today. Locally, nothing is on the horizon till the Reserve Bank of India credit policy, which is due on 17th of June. So what do you think locally will have an impact on Indian markets for next 2 or 3 days?
I think it's got to do more with how the government moves in terms of managing inflation. Particularly, we are also kind of almost expecting a 1 rupee rollback not rollback, but a price cut on the petrol prices that could sentimentally improve things for the markets. But the diesel price hike, which has been deferred, which has been talked about so often and not been worked on, I think is something that people would like to see. LPG, diesel, those are concrete issues that would need to be worked on to make the markets look at some better triggers. But till that happens, I don't think there's really much of cues. Inflation, some of these macro issues which are hurting us since a long time, and of course the state of the political stability that is itself getting questioned now, which I think would be the more domestically oriented cues.
Prakash, let's discuss that point. It sounds like a lame trade. If there is weakness in rupee, go and buy rate sensitives, buy IT companies, buy pharma companies, because they will benefit as they are exporters. Do you think that trade sounds easy, but in reality it's difficult to implement, because if markets correct, these rate sensitive sectors and rate sensitive group of stocks will also correct?
No, certainly, Nikunj, you're right. Not only the fact that rate sensitive would see a deeper correction if the liquidity actually dries out. The other sense of worry is today if you look at the Nifty, there are 28 stocks which are if I remember correctly on the 52-week highs, and there are 31 stocks. Those are on their closer to their 52-week lows. So we have a market which is kind of completely polarized. So what's happening is there's this whole aversion to certain sectors and certain stocks, which is fairly unreasonable, and particularly cap goods, infrastructure, telecom. Whereas you have the second set of stocks where we're getting into an overpricing kind of overbought zone, and pharma definitely happens to be one of those. So what's likely to happen is these stocks will end up losing a lot of that ground that they've gained in the last couple of months. And the drop could be much sharper than what you would be happy with. And not only rupee depreciation, but my sense is rupee depreciation with a situation where for the month of June, particularly first half, if you don't see liquidity flows come in because of the European crisis, again precipitating into a much bigger thing, as we get closer to the Greek the referendum, I think it's going to get very difficult to salvage the situation from the RBI's point of view, from the government's point of view, and that could get markets into a tizzy and maybe test those lows again of 4650, 4700.
If I look at what brokerages are of the view, and if I look at the intrinsic value of JP Associates, is about 150 rupees per share. The stock is available at 60 rupees. They are India's third largest cement maker. They've got a strong land bank. They also have operational power plants. But irrespective of the assets they are sitting on, the stock has been a big underperformer.
No, absolutely, Nikunj. The high book value actually stems from the fact that they've invested a lot into fixed assets. There's been a wonderful asset creation journey that this group has undertaken in all its three verticals. But mind you, it's quite debt laden, and what brings it down from a market perspective is that most of these businesses that they are into are not yet anywhere close to the completion stage, except for the cement business, which has been probably the one that started off or got off the blocks the first. But the whole fact is that the value realization in this group as a whole, and the stock particularly, will happen once their the cost of their debt comes down. Even if there's a marginal 50 basis points effective rate of reduction in their interest cost at the EBITDA level, it would significantly impact the EPS. So what's very clear is, if the moment, this is going to be a proxy for rate cuts, and if the RBI goes ahead and cuts about 100 bips for this entire FY13, JP Associates definitely would move at least 50% from here on. So it's a stock that is for long-term investors. It's not something that investors would have the gumption to buy for just a short while and trade on it. But it's definitely, as you rightly said, the trader's delight, because it's a high beta stock, moves in sync with markets beyond what the swings in the market are. But my sense is it's close to its fair value, in bottom value, where intrinsically people should be looking at buying in from a much longer term perspective and not just a trading perspective.